Seabury in Ontario. Joey?
Thank you, Bart. So the Inland Empire is comprised of two markets, the West and the East, and for the benefit of those not familiar with the Inland Empire, it's an extremely large market with boundaries stretching east to Banning, west to Chino, north to San Bernardino, and south to Paris. The theme for the Inland Empire in 2011 and heading into 2012, bigger is better. In 2011, we saw strong demand for space 500,000 square feet and up, and as we head into 2012, we feel that demand will continue. So currently, in the Inland Empire, there's approximately a dozen requirements north of 500,000 square feet, active requirements. Next slide, Martin. So we'll take a quick glance at a few market stats. The base for the Inland Empire, just under 400 million square feet. We have about 242 million square feet in the west, and a little over 155 million square feet in the east. The overall vacancy rate in the IE was about 6.8% in 2011. We saw about 10.3 million square feet of absorption, which was down slightly from 2010. Gross lease activity totaled about 24 million square feet. Compared to 2010, gross user sales activity was down about 2.7 million square feet. And looking at the chart, one of the stats I find most interesting is the construction deliveries. So we saw about 3.2 million square feet of new construction in 2011, and as we head into 2012, we already have over 4.2 million square feet of construction already on its way. So, and I might add that the Inland Empire is one of the few markets that's seeing the return of spec development, so that's a good sign. And lastly, and I'm sure no one's surprised, lease rates, sales prices, both trending upwards. Next slide, Martin. So a quick recap of 2011. As mentioned previously, there was and continues to be strong demand for space 500,000 square feet and up. In addition to assisting with the overall vacancy rate, this demand has also helped drive availability rates down. And although net absorption was down approximately 10% from 2010, I still feel that it's a pretty impressive number due to the lack of available existing buildings. So once again, as a result of supply and demand, the Inland Empire saw significant rent growth in both big box in the east and the west. Next slide, Martin. So as you can see, I've highlighted a couple lease transactions here, one in the east, one in the west. In the east, the IDS group leased approximately 616,000 square feet from the Watson Land Company. It was a 10-year deal with a start rate of 33 cents net. The deal included $2.50 in TIs and 10 months of free rent. The effective rate on this deal was 34.3 cents net. And what I found most interesting about this deal is the fact that Watson had made the decision to build this building spec. IDS was in the market. As we all know, have limited choices for buildings that would meet their timing and space needs. And at the end of the day, the lease was signed prior to building completion. So the second transaction you'll see there is the Georgia Pacific deal with Prologis in the fourth quarter of 2011. It's in Ontario, 763,000 square feet. 26-month deal. The effective rate on this deal was 39.5 cents net, and that included 30 cents in TIs. And again, same trend. Prologis was really the only group that could deliver an existing building to meet the tenant's time frame. So the next slide, please. A land transaction, one of the more significant land transactions that took place in 2011 involved Trammell Crow and Comar Investments. Trammell Crow purchased just over 76 acres from Comar and Reno Valley. The site's located at the northeast corner of San Michelle and Heacock. It's a total value of $20.5 million, which equates to about $6.16 a foot. Speed to market was the main driver here once again. And you're already there. So in my opinion, one of the most noteworthy deals was not a single transaction, but actually a string of deals that dates back to 2010. In short, two buildings totaling approximately 1.4 million square feet were sold vacant, leased for 10 years, and then sold again as a leased investment. So going back to 2010, CBRE investors sold CT Realty in West Corp 2 vacant buildings in San Bernardino for approximately $36 a square foot. Shortly thereafter, in the first quarter of 2011, HP came along and leased both buildings for 10 years. The lease was driven really by the need to consolidate 3 existing California facilities into a single building or a campus environment, and due to the timing restrictions, build-to-suits really weren't an option here. So the leases were signed with a lease rate of start rate of 29.5 cents triple net and 2% annual increases. And lastly, the string of deals concluded in the third quarter of 2011. An investor bought both buildings as leased investments for approximately twice the purchase price paid in 2010. So last slide. So as we look ahead, we expect the availability rate to hover right around 11%. Declining availability rates will lead to rental improvements. We expect to see import growth in 2012, which we believe will continue to drive demand even more so in the Inland Empire. And even though several new projects are slated to break ground, I feel new construction will grow slowly until rates for all building sizes rebound. And in summary, with strong demand again for buildings 500,000 square feet and greater and minimal new construction, I believe existing owners, investors are in a very good position going forward. Thank you.